the dynamics of the debt trap are basically when you get an increase in the cost of that debt in the form of interest rates that is increasing at a rate faster than the rate of GDP growth, then you're in a debt trap. It's quite simple. It just goes to the point where suddenly nobody's going to lend to you because, well, I mean, what do? You put up the interest rate, and the interest rate then works against you because it makes that relationship between interest and GDP, interest growth and GDP growth, it makes it even more disfavorable to GDP growth. And, the debt, if you like, the interest rate side of the equation rises even faster. It's a classic debt trap. And we're on the verge of it. And what happens in both America and the UK is we have a large contingent of foreigners who we rely on to buy our debt. They will go on strike unless the interest rates are higher. But as I said, if the interest rates are higher, we're dead anyway. So we've got ourselves into this silly situation from which there is actually no escape. That is the definition of a debt trap.
On this episode of the What the Finance podcast, I have the pleasure of welcoming back Alasdair Macleod. So Alasdair is the head of research at Goldmoney, and he also has a great Substack as well, which I think he covers a lot broader analysis of not just gold, but sort of the monetary policy, the monetary system, what's happening around the world. So I'd recommend looking at that. But Alasdair, thanks so much for coming on the podcast today.
That's my pleasure, Anthony.
I'm looking forward to the conversation. Lots been happening in markets and the economy in general since we spoke sort of 6 months ago. But yeah, I guess from your perspective, broad overview, what are you currently seeing?
Well, I see equities wildly overvalued. You just look at the relationship between bond yields and equities, and they are very, very overvalued. Having said that, bond yields are going down, but they're going down because of recession fears, which is not good for equities anyway. So I think that's one thing. The other thing is that the dollar's debt trap is becoming more and more of a topic, I think. And in general, as people understand that the inflation problem hasn't gone, and therefore interest rates might come down in the short term, but are not going to stay there in the longer term, then I think that there will be a growing understanding that there are real problems, particularly in the US economy, but also in the UK economy. The interest costs on gilt debt are just soared through the roof. We're a minor version, if you like, of the US's problems. So, both UK, US, not good. I don't see very much to be joyful in Europe. I don't see very much to be joyful in Japan. And of course, we've got the threat of an escalating war going beyond, if you like, just the purely proxy relationship through the Ukraine. So there's quite a lot. And I haven't even got round to mentioning the Middle East, which is another bag of worms, I'm afraid. So I'm desperate to find something nice to say, but it's actually rather difficult.
Yeah, and hopefully maybe at the end we can be a bit more positive and maybe see if there's anything that can bring us up. But, you mentioned there about, I guess, risks that we're seeing in the economy. I know, oil is absolutely crashing. We've seen industrial metals crash as well, I think linked to China and slow down there. So is that really, in your opinion, linked to this recessionary issue as well as potential stagflation moving forward?
Yeah, it's actually, markets are a bit of a nonsense on this one because they're pricing a US recession or trying to price a US recession and therefore a global recession and all the rest of it into the situation. And they do this through the futures markets. And the whole point about a futures market is that you assume that the currency in which you're pricing it, which is dollars pretty much always, is stable, but it's not. It's going down. And sooner or later, you'll find that there's a big mistake pricing metals down when actually it's the dollar that's going down. And at some stage, I think that's going to become apparent. So markets have got this horribly wrong, but they can be wrong for quite some time. But But I suspect there's so many things going wrong underneath all this that it could be a little difficult to predict in the short term.
Okay, that makes sense. But you don't. Are you thinking there is recessionary issues, or it's not really sort of
Yeah,
what you're
I
watching at the
mean,
moment?
there's no doubt about it. I mean, the problem is that trying to measure an economy by GDP, growth in GDP, is a complete nonsense. It doesn't tell you what's going on in the economy at all. All it tells you is how much credit there is in the economy. And, it doesn't tell you how that credit is deployed. If the credit is deployed productively, then whoopee, that's great. I mean, that's what we call economic progress, which actually is what we're seeking. But if it's not employed productively, then it's completely meaningless. In fact, it's inflationary. And you've only got to go around. I mean, in the UK, go around the provinces, have a look at what's going on the high street, the number of charity shops that have opened. Why have charity shops opened? Because they don't pay business rates. Businesses cannot afford to pay business rates. Taxes are going up. The whole thing. I mean, the bulk of the economy is actually suffering, and it's exactly the same in America. I mean, we've just got sort of rather used to it, so it doesn't hit the headlines anymore. But it is not good. We are definitely, in, if you like, a business slump. And to just try and measure it in terms of GDP, which is no more than the quantity of credit deployed, is very, very misleading. So yeah, we're already suffering, I think, and a rise in interest rates is going to tip an awful lot of companies into real distress. I mean, in the UK, we've already got this with Thames Water. I mean, there is a company with a utility income stream guaranteed by a regulator and all the rest of it. Took on an awful lot of debt, or at least it was made to take on an awful lot of debt by the hedge funds and private equity that bought it. And now, of course, interest rates have risen and it's bust. There are a lot of businesses in that position.
Yeah, no, it's crazy to think, and that's one of the issues as well. They leverage a company, don't invest in anything, and then there's this massive capex outlay at the end, which they can't afford, and government has to come in and pay for that. So, unfortunately, I think that's going to be something that's going to be continue. So, are you thinking that this debt? I guess you're saying that the debt hasn't been allocated to properly throughout the economy to productivity increasing. Investment, is that just because of the low interest rates artificially impacted the markets? Is it just focused on capital returns? What do you think the focus, or why do you think that's happened?
Well, I mean, if we're looking at credit as a whole, then the two aspects of credit which mislead us into believing that we've got growth in GDP are the government budget deficit, which is almost exclusively spent into GDP. That's not productive. And then you have got the expansion of consumer finance, which is partly covered by the withdrawal of savings, but also covered by things like credit card debt increasing and motor loans increasing and all the rest of it. That's not productive, really. So the whole situation is that the expansion that we're seeing in credit, leading to the increase in GDP, is actually not productive, and it's inflationary. So this is not good. I mean, I first discovered the effect, if you like, of government spending on GDP and how misleading it is back in the days when Gordon Brown was Chancellor. I mean, that was 1997, 98, I think. I mean, he consistently managed to make the economy look good by excess government spending. And every time, the GDP numbers were forecast, he always beat the estimates. But I mean, the whole thing was a load of hogwash. I mean, it was a fix. And I think everybody's hanging on statistics, and the statistics are completely meaningless. They really are. Sooner or later, they'll find out that is the case the hard way.
And what do you think that would look like when they find out? Is that just going to be they're going to have to drastically cut back their spending? Do you think that's going to be a currency depreciation? I feel like that's probably where you see that happening.
Well, I don't think the political class are going to cut back on spending until there is an absolute disaster and they're forced to do so. I think in the UK, I mean, it's interesting. The House of Lords released a report, I think it was today or yesterday, I mean, very, very, very recently, certainly, about the debt situation. And, the interest cost has just gone through the roof. I mean, there's a lovely chart in there which just illustrates it. So there are people, if you like, in the political world who do actually see this, but this is yet to be accepted, I think, by the policymakers. They want to continue to spend, and our wonderful new government, I mean, the first thing they've done is give very, very expensive pay settlements to their cronies in the unions and, in the NHS. Our NHS, we're told. I mean, it's not our NHS, it's the government's NHS. They're providing the service and they don't do it terribly well. So, I mean, the economy basically, I think it's approaching a cliff edge. I really do. And it may not be the UK's problems that actually trigger it. I suspect it could well be America's problems. We've got a presidential election, and at the moment we're sort of focusing on the politics and assuming that there's sort of stimulation and all the rest of it in a political, in a presidential year, and you get idiot theories like people say, well, the markets don't go down in presidential years, or whatever the meme is of the moment. I made that one up, incidentally, but I don't think it's too far from the truth. So, but I mean, you look at both the presidential candidates. Trump is talking about massive cuts in taxation, and he's also talking about massive cuts in public spending. That's not going to happen. I mean, for goodness sake, it really is not going to happen. And as for Kamala Harris, she knows absolutely nothing about economics. We've just got to pray that she takes good advice, but I wouldn't hang around and assume that she would be given good advice, because, the track record of presidential advisors doesn't actually fill me with confidence. So, yeah, I mean, it's just not looking good. And I think that the other aspect of this, and I'm writing an article on it actually for publication later this week, which probably come out, I don't know when this recording comes out, but I suppose about the same time. I think that Russia in particular is being forced into a position where she will take avoiding action. By avoiding action, I mean in the financial sense. It is so clear that she should go on to a gold standard. I mean, absolutely clear. She's got interest rates of 18%. Why? Because nobody trusts the fiat ruble. It's not because her economics are rubbish. It's because nobody trusts the currency. And put it on a proper gold standard is very easy to do. My article shows how to do it. So, it's one which people might like to read. Suddenly I think that the Russian situation will begin to resolve itself, and from Russia's benefit. And the other thing, of course, is that as soon as someone goes on a gold standard, it's rather like the fable, if you like, about the little boy who cried out that the emperor isn't wearing any clothes. I mean, I think I'm right in saying that the Americans, one of the reasons they brought about regime change in Libya was because Gaddafi wanted to set up a gold-backed Central African currency, which didn't go down too well in Washington. So, yeah, Russia could do it, and I think the Saudis would follow. And I think they're going to be driven into that solution, if you like, to protect their own currencies in face of a dropping dollar. And the other thing is that Trump has said that if he gets elected, he wants a lower dollar anyway. So, not a lot to like, I'm afraid.
No, definitely, and we'll get to that later. And I think our interview is going up on Friday, so I'm sure the article will already be up then.
Yeah.
But if we stay on debt just for a little bit, and then we can get into all those pretty interesting topics. You know, the government debt market is very large, but then there's also the shadow banking private debt market as well. So do you think that could be sort of something else that you know could lead to these issues moving forward? Because I think some of the the gap between private and public debt isn't that high. It's actually very surprising.
Yeah, but the difference is that debt in the private sector, as long as it's not financing consumption and it's financing production, is actually non-inflationary. If anything, it's disinflationary in the sense that it leads to falling prices. So, I mean, I would say that private sector debt is very, very different from public sector debt. Very, very different. And you can't just make a straightforward comparison. The idea that that if you look at sort of total debt, sort of total debt in the economy, they say something like, I don't know, I'm just making a figure up, 300%, of which government is only 100%. The problem is in the private sector. No, it's not in the private sector, it's in the government sector, because it spends in excess of its tax income unproductively. It is therefore inflationary. That is the debt that's the problem. And the debt trap, the dynamics of the debt trap are basically when you get an increase in the cost of that debt in the form of interest rates that is increasing at a rate faster than the rate of GDP growth, then you're in a debt trap. It's quite simple. It just goes to the point where suddenly nobody's going to lend to you because, well, I mean, what do? You put up the interest rate, and the interest rate then works against you because it makes that relationship between interest and GDP, interest growth and GDP growth, it makes it even more disfavorable to GDP growth. And, the debt, if you like, the interest rate side of the equation rises even faster. It's a classic debt trap. And we're on the verge of it. And what happens in both America and the UK is we have a large contingent of foreigners who we rely on to buy our debt. They will go on strike unless the interest rates are higher. But as I said, if the interest rates are higher, we're dead anyway. So we've got ourselves into this silly situation from which there is actually no escape. That is the definition of a debt trap.
Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in and for your support over these 3 years. So we've had, hundreds of guests that we've welcomed on the podcast. We've had millions of views. We've hundreds of thousands of different people listening in. So I just wanted to thank you. I started this as a student and now currently working and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people, and you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So if you can, great. If not, no problem at all. Thanks for listening, and let's get back to the show. Yeah, and probably can't Japanify sort of the debt, can you? Because I guess they can do that because they have all this so much pension invested.
Yeah. I mean, they fiddle the figures big time. But the key difference between Japan and us and the US is that in Japan, they actually have a savings culture. So in other words, when they expand the quantity of credit in the economy, it just goes into savings rather than immediate consumption. That is why their inflation numbers are lower and why, therefore, they can continue to run with a lower level of interest rates without killing the yen. Now, obviously, there is a limit to which that applies, and it's not a pure argument because the government does actually subsidize things in the CPI like transport costs and so on and so forth. But the key thing is that if you've got a savings-driven economy, you have lower inflation than you will have in an economy without savings or with falling savings. And that, of course, is it was the old Anglo-Saxon problem. I mean, if you go back to pre-Euro days, we knew exactly the difference between what was going on in the Anglo-Saxon economies, in other words, the US and the UK, compared with, in those days, Germany under the Deutschmark and Japan with the yen.
Yep, and I guess that's sort of what's happening in China as well.
Yes, you're absolutely right. I mean, the savings rate in China is enormous. The estimates say that, and again, I always qualify these statistics, but there is little doubt that in China the household savings are enormous. I mean, the statisticians say that they amount to 35% of GDP. Now, that's the equivalent of $6 trillion. $6 trillion every year. It's no longer going into property. If you look at the sort of Shanghai stock market index, that certainly doesn't enthuse anyone. I mean, it's been in a bear market for 3 years, apart from this year when it's actually picked up a bit. But that's not likely to enthuse the housewife, if you like, in Shenzhen or wherever. So where does it go? It goes on to bank deposits, and they're lowering the interest rates because they're trying to stimulate the economy. I mean, the Chinese have a touch of Keynesian fever, I think. But the important thing about this is that this money, these savings are likely to flood into gold. Why? Because there is really nowhere else for it to go other than bank deposits, which are now paying even less.
Yeah, it's a great point. Maybe you can go into gold now, because I think it's something that no one seems to be talking about it, even though it's at all-time highs. Why is that? Why do you think that's the case?
Well, it's I think it's an extremely good question. I don't think I've ever before seen something which is widely circulated and quoted on markets, which hits new high ground without public participation. I mean, the answer is that the public participation is there, but it's in countries like China, India, and other Asian nations. It's not here. I mean, we've been liquidating ETFs as savers, if you like, in this country, or investors in this country. It's all part of everybody being fast asleep. They just don't understand what's going on, Anthony. I mean, they're asleep. Wake them up, shake them by the shoulders. But what it does mean, I think, is that you've got buyers, sellers of dollars and sterling and euros and whatever. They have yet to sell their own domestic currencies and buy gold, and it'll happen. And it'll happen probably at a far higher price.
Yeah, and that's when you see, if you get the sort of crash, the debt crash, as well as the currency crash, they're going to start trying to flood into these precious metals.
Yeah, you get. I mean, there are two stages in this. I mean, we're seeing the first stage at the moment, and I think the best example of it is the People's Bank of China. Everybody thinks that the People's Bank of China has been buying gold. They got it the wrong way around. Actually, what they're doing is they're selling dollars. So they're trying to get out of dollars. Now, there is a political element in that, sure. But the Chinese can see exactly what's happening. I mean, the debt trap, which I've just described, the Chinese understand this. They're not idiots. The Russians understand it, and they're just watching the whole thing about to topple over. And, and nobody wants to get blamed for the whole thing falling over. But the foreigners in particular understand that you've got to sell dollars. So what do you buy? Do you buy euros? Sterling? Not really. I mean, you might get out of dollars into some of that stuff, but it's in exactly the same trap as the dollar, just maybe not quite so bad in some cases. Where do you go? You go into gold. Why gold? Gold is legal money without counterparty risk. All the rest is credit with counterparty risk, particularly fiat currencies. I mean, what you have with the dollar is it depends entirely on the faith you have in the US government. Foreigners' faith in the US government, is this something that is likely to persist? I think foreigners at the margin are beginning to doubt their faith in the dollar. And it always starts with the foreigners. They're the first to understand that they shouldn't be holding a fiat currency. The residents of a country who use the currency don't actually appreciate this in the initial stages. They will do a double take on this and they will think, well, prices are rising. This is terrible. They don't actually connect it with the falling purchasing power of their currency. But when they do, then the currency is toast, it's had it, it's finished. And that, I think, is the next stage. I mean, I don't know how long it'll take for people to begin to understand this. But I can tell you, domestic residents in America and the UK do not understand this at all. They think a pound is a pound, a dollar is a dollar, and I can, go out and spend it, hang on to it, whatever. And its price is rising as far as they're concerned, not the purchasing power of their currency going down. At some stage, they will wake up to this. And then it's finished. It really is finished. The fiat currency world is finished. And I don't know how long it'll take. I mean, in the 70s, we got nearly to that point, really, I think, following the devaluation, which was 1968, something like that. And then we got to, in the 70s, we had the crisis where the IMF bailed us out in sort of around about the end of 1975, beginning of 76. Interest rates had to rise to 15% plus. I mean, well, that was a coupon on 3 of the gilt issues, admittedly medium dated ones, and the government was forced. The Labour government at the time was forced to do something which it really didn't want to do, and that was raise taxes, cut spending, which it did. It had to bring the budget back into balance, and the thing was saved. We're a long way from this sort of activity. But until then, the currency was collapsing. I mean, I remember briefly, inflation was recorded at 24.5%. Think what that does. So this sort of 70s problem, which I think we now face, is all ahead of us. And but this time, after all this long period of fiat currency suppressing interest rates, etc., I don't know how long it will be before the whole system falls apart, but probably not terribly long. Year or 2, maybe 3 if you're lucky. That's assuming, of course, that the conflict in Europe and the Middle East doesn't flare up and hurry things along. That's a separate question. But even without that, we're not in good shape.
Yeah, it's scary to think. And I think maybe, some people are realizing this effect with the inflation we've seen over the past few years. It's not to the extent of what you saw in the 70s, but it's still just definitely hurt a lot of people.
Yeah, I fear so. But you ain't seen nothing yet. Was it Yogi Berra who said that? It's I think there's quite a lot to worry about. And when it comes to Ukraine, you can see it's absolutely clear that there's a huge strategic mistake being made by the Ukrainians. I think pushed by us, because both the UK and the US, I think, have encouraged the incursion into Kursk. Some sort of bridgehead, some sort of create the precedent that we can, steal some of Russia from Russia and get away with it and all the rest of it. But actually what it's done, and any military strategist would have said this is crazy. What it's done is it's just divided Ukraine's forces. It's taken elite troops away from the Donbass, protecting the Donbass and the eastern borders of the Ukraine, into a ridiculous operation without any air cover, and really no troops there to fight. I mean, they're just going round and round and round in circles, and the logistics of supplying them put further strains on the whole thing. And meanwhile, the Russians are happily bombing sort of military centers, if you like, within the Ukraine, killing even Swedes. I mean, why Sweden is in this, God alone knows. The government signed up for this NATO thing without even consulting anyone in their populations. And when I went to Sweden not so long ago, I can tell you that there's a certain amount of anger about that. And rightly so. I mean, the country has stayed out of wars by being neutral since shortly after the Napoleonic Wars. We're making mistakes after mistakes with Ukraine. And my own personal view is that I don't think Zelensky's actually got very long. I think, he'll probably be chucked out by Ukrainian forces. I mean, I think that there is a general discontent within the Ukraine about how this is going. I mean, we could, Zelensky could have accepted a peace proposal almost at the beginning of this. I mean, after a couple of months, there was an arrangement, if you like, whereby they were all meeting in Turkey in order to sort this out. And then Boris Johnson came along and said, don't under any circumstances agree to a peace deal. And what's happened? I mean, how many tens of thousands of Ukrainian lives have been lost since then? I mean, we're culpable in this. This is not good. And we're dismissing it all with propaganda. I mean, wake up.
Yeah, it is really sad to see. So if we go back to gold, I guess, and what's happening there, and you've talked about, Russia and they're sort of wanting to build this, or, the potential to build a gold standard. What impact will these flows from west to east have on, I guess, the Western countries? And then, maybe we can get into the building of a proper gold standard and what that requires.
Well, if you look at history, fiat currencies only last a certain amount of time. Our fiat currency system, which I suppose has basically been, well, sort of post-war because it was a fiddle under Bretton Woods. But when Bretton Woods fell apart, then, I mean, we're looking at 53 years of fiat currency, pure fiat currency. I think it's almost time now, if you like, if you look at the survivability of fiat currencies, we've done pretty well lasting this long. It's now, I think, about to fall over. I mean, as I say, I don't know whether it's tomorrow or in a year's time or 2 years' time or 3 years' time, we'll see. But we will go back to credit being secured to the value of gold. And in order to do that, you need to have as much convertibility as possible from what becomes, instead of being a fiat currency, it becomes a gold substitute into gold, and vice versa. And a properly constructed gold standard basically means that nobody bothers about gold anymore, but the values are secured to it, which is the important thing. And you don't need to hold gold. You can actually hold the currency and use it productively. But the one thing that is necessary for this really to work is to have an economy which isn't dominated by government spending and has relatively low taxation. So there is the incentive for entrepreneurs to rush out and invest capital in production. And actually, this is precisely the situation in Russia. The debt to GDP in Russia, government debt to GDP, is in the order of about 22%. And that's even after all this war spending. It's just remarkable. I mean, obviously, they've managed to achieve this because they sell an awful lot of oil and other commodity exports. But the other thing is that the level of taxation is a flat rate of tax of 13 to 15%. I mean, if you're really earning a lot, it's 15%. No more than that. Corporation tax, I think, is in the order of about 25%. So That's pretty normal, I suppose. So Russia doesn't have to do an awful lot to, in terms of evolving its economy in order to put it on a gold standard. It could do it tomorrow if it cared to do so. And it's very easy for a country which actually understands what it's doing to build its gold reserves and maintain them so that that cover is always there for the currency. And, in this article, which will be coming out, as you say, on Thursday, probably slightly before this comes out, actually explains the whole thing. I mean, it's very easy to do. But of course, the problem in the West is that governments don't like a strict, sound currency because it means they can't just sort of print it at will. They can't just finance their deficits at will. The politicians just want to spend. They don't want the constraints of the market. They don't want the constraints of gold. So, basically, they will continue to spend us into bankruptcy. But Russia and China, for that matter, will need to protect themselves from our collapsing currency, because if our currencies collapse, any other fiat currency will go with it. I mean, because it's the whole of the fiat currency system which is really well past its use-by date. So Russia, I think, is going to have to consider doing this. Now, of course, at the moment, everybody's talking about BRICS bringing in a gold-backed currency, which, of course, makes an awful lot of sense. But I mean, looking at the, how that's developing, I mean, there are a couple of guys who actually aren't even appointed by any government agency. One Russian, one Chinese, makes you think that this was a government thing. No, they're just fund managers, actually. They've come up with this proposal called a unit. And it's clear from the way they've constructed, they don't understand the difference between money and credit. I mean, there's absolutely no mention in their paper about the interest rate which the unit will bear. I mean, it's got to have an interest rate, otherwise there's no point in having it. So you can see that there are big flaws in their arguments. It's not only that, it's not something that either China or Russia as governments have engineered, if you like, to put on an agenda in the big summit in October. And at the moment, they're all sort of, going around in circles, trying to sort of say, well, this is going to be difficult, because we want to have a basket of this and a basket of that. I mean, it's just complete nonsense. They will never agree it. So that's not going to happen. So from Russia's point of view, she's got to put herself on a gold standard. And then, it's actually very easy for a new trade settlement currency to be put on, to be created onto a gold standard. You could do that tomorrow. And I think the answer actually is, if they really want to do that, you don't sort of put it on the agenda or whatever. You create it and then you say, well, it's there if you want to use it. And they'll use it. It's quite simple. So I think there's a lot of misinformation, disinformation, whatever, about the whole thing. But I'm convinced that Russia will go on the gold standard because it is so definitely in her interest to do so, either as an aggressive weapon against the dollar, or more likely to protect the ruble from a collapse in the dollar. Because as I say, the dollar is in a debt trap. When we were in a debt trap back in the mid-70s, we were rescued by the dollar and the IMF. There is nothing to rescue the dollar. So from Russia's point of view, I'm sure she's already thinking in terms of a gold standard. Now, whether she implements it properly or not, of course, is another matter. Because you have the problem that central bankers got very jealous about the gold that they have accumulated in their reserves. They don't want to give it away to anyone, let alone their own population. So you can see that, there's some vested interests which have got to be overcome. But it's so simple, it really is. And as I say, my article just lays it out. Anyone who doesn't know how to do it, read the article.
Okay, and I'll put the article description so people can read it. But I guess, is this only possible if you're a exporting country? So say if you have these large commodity, resources that you export to the world. Is that the only way that you can actually have that gold-backed currency, or how else can you do it? Because it seems like otherwise it's just going to be constantly gold flowing out as people swap it for your currency. No.
No, Anthony, no, not at all. The answer is that your gold reserves are maintained by having the correct level of interest rates. Interest rates will ensure that gold flows into or out of your reserves in the desired quantity. I mean, this is the thing that they learned from the errors in the drafting of the 1844 Bank Charter Act. They didn't understand that the important thing is that it's the interest rate, because if your currency is a proper gold substitute, right, then what you can do is you can go into another country, buy gold, which, I mean, if you look at the lease rate at the moment, it's 2% roughly, okay? So your cost of gold is 2%. In Russia at the moment, the central bank's deposit rate is 18%, or their main rate is 18%. 18 minus 2 is a 16% margin. I mean, and what are you being paid in? You're being paid in rubles, which are a gold substitute. It's just the same as being paid in gold. So, the arbitrage is very, very simple. And that's the way in which you balance your gold reserves. It's got nothing to do with your trade. Your trade is actually more a function of government excess spending if you've got a deficit. I mean, it's quite simple. You just got to back the currency properly and use interest rates for that purpose, not for trying to manage the economy to sort of, which is huge mistake. And this is where the central banks have got the whole thing so horribly wrong. They don't understand that the function of interest rates is to do with the purchasing power of the currency, maintaining the gold reserves. It's got nothing to do with stimulating the economy. That has to go. So you put it into an issue department, keep it out of the banking department, keep it in the issue department with simple instructions. You run interest rates, issue department, and you run it with an eye to maintaining your gold reserves. Full stop. Not difficult.
Okay, look forward to reading the article. So, Alasdair, thanks for your time today. Really appreciate it. Last question is, what is one message you'd like people to take away from our conversation?
I think what I'm trying to do now really is to educate people from what I see as economic catastrophe. It's the accumulation of the mismanagement of our economic affairs, which actually go all the way back to President Hoover when he tried to start interfering in the economy to try and get an outcome which was sort of favorable. I mean, with the best of sort of Christian intentions, if you like, but huge mistake, because until he came along, everybody knew that the worst thing a government could do is actually interfere in the economy. And, you would have the cycle of bank credit, which led to, slumps and all the rest of it. But the slump, if you interfered with it, the slump just prolonged. And that's actually what happened in the 30s. But ever since then, I mean, particularly Keynes, he came up with he invented macroeconomic theory on the back of his general theory. And it was the excuse for governments to continue to intervene and just make things worse. And this is all culminated, I think, in a crisis today. The first crisis was it drove the dollar off the Bretton Woods system. It ended the Bretton Woods system. And that was, as I say, 52 years ago. And since then, I mean, we've just sort of struggled with these currencies, which have lost huge amounts of purchasing power. I mean, if you look at the dollar, measured in gold, which is real money, legally real money, incidentally, the dollar has lost over 98% of its purchasing power since 1971. In fact, if you go back to the rate at which it was fixed in 1900 and was changed in 1934, which was 20.67, it's lost over 99% of its purchasing power. That is the degree of corruption of monetary value that has happened, and it's entirely down to governments. Entirely down to governments. That's got to change. That will change, and I want to educate people as to the difference between money and credit, what is actually going on with credit and the risks in credit, and how they should protect themselves from those risks. And that is the purpose of my Substack.
Perfect, Alasdair. Great message. So thanks again. You mentioned the Substack. I know you are quite prevalent on X as well, so I'd recommend people follow you there. But yep, thanks again for your time.
Lovely. Thank you very much for having me, Anthony.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment. You know, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right, thanks again.